I want to thank everybody for participating, or at least hearing what we've got going on. There was a panel, very interesting discussion not too long ago on alternative investments, and that's what this is. I'm going to share with you the attributes of the fund. It's a small micro fund, purposed specifically for members of TrueSpace, and I'm going to give you some context around who TrueSpace is, and it's in essence how we are able to mitigate the risk in the investment. But let me describe the partners in the fund. I'm the managing partner. My background has been 43 years in high technology. I've run 5 companies by outcome, but not by design, as a turnaround CEO. When early investors get into startup companies and emerging growth companies, and lots of times things don't turn out the way the investors had hoped they'd be. I have found myself going into these companies and figuring out what's wrong, what happens, why do they stall. So that's my context, is having been on the recipient end of investor money, and frankly, having replaced founder CEOs that end up working for investors without having any return. So that's part of my mission, is to help CEOs keep their business and keep the majority of equity in their business. Charles and Jamie Fred, the co-founders of TrueSpace, Charles Fred has started and sold successfully 3 companies into the middle markets. His experience also has informed what we do and why we're creating this debt fund for TrueSpace members. Jamie is the president of TrueSpace and a partner in the fund, and has worked, again, co-founded, and I'm going to talk in a little bit about the research that they did that underpins the basis for the investments that we're making. And then Tanner Moya is the CFO of both the fund and for TrueSpace, and a partner in the debt fund. So let's talk about the reason we're doing this. There are today about 2.1 million companies in the United States that make it to $1 million in recurring revenue. However, is less than 3% make it to 10 million, make it to the middle markets, which is how we define the beginning of the middle market. So very, very small percentage. The research that we're going to talk about was driven by the question, why is that the case? How is it that companies can get to $1 million, but 97% or so can't make it to 10 million? Most of these companies have exhausted the early seed money. Money comes in, they put it to work, the great ideas don't work out, they run out of money, and they start floundering. The challenge they get into in this situation is that they're at a stage where they've proven enough that they can get to $1 million, but they haven't got the attributes or the proof points to really be a good investable business by most sources of capital. And banks don't want to lend to them because they can't meet bank lending covenants, right? So we find ourselves with a lot of companies that have capability of growth, but they simply have no access to the capital to help them build out and build the proof points. The additional challenge is that there's only about 20% of these companies that are run or owned by women, and even fewer that are run by non-Caucasians. So it's a real space that is ripe for potential and growth, but very, very underserved. Our estimate is there's about 378,000, so roughly 400,000 of the 2.1 that can grow. Not all of them can grow. Not all of them are going to scale. Why? Because a lot of this 2.1 million companies are small business that are lifestyle businesses. They may be small retail operations, 2 or 3 store restaurants. But there's about 400,000 that have the capability of growth. And that's the target market for our work with TrueSpace and the fund. So what's the fund? The fund is an aggregate $15 million debt fund. We're carving it up into 5 micro funds, and I'll talk about in a minute. It's non-dilutive capital for the owners. Over half of the money, our target is to invest in women and minority-owned businesses. We think it's a very low-risk opportunity for, particularly for individual investors and family offices. Why? Because it's underpinned by the research that we've got that clearly demonstrates the conditions needed by these companies to scale to the middle markets. And I'm going to talk about that in a little bit.
Can you repeat, is it a 15 or $50 million fund?
1.5.
Okay.
1.5. Total 15 million aggregate fund. We're dividing this fund into 5 micro funds specifically to allow targeted investment by interested investors. The first of these funds is subscribed. So we've got 4 funds that are open for investment. Our average loan size is 500,000. We're gonna loan money between 250,000 and probably as much as 750,000. Why? Principal reason is most of these companies don't need millions of dollars, which is why it's difficult for them to get venture capital interest in it. It's just not enough money to put to work. The other reason is we don't want heavy concentration in any one of the companies. We want to mitigate the risk. They are 4-year term notes. We'll charge low double-digit interest rates, so think 11, 12% interest rates. Our payout to the investors is 8%. So it's a committed 8% annualized interest, principal and interest paid out over the term of the loan on a monthly basis, monthly distributions. The first fund is being used to help member companies finance their membership. We charge $30,000 a year to be a member of TrueSpace. And we're going to talk a little bit more about what that gets you. The second fund is targeted for women and minority. Our third fund has been identified as a general fund. We've got now in TrueSpace about 55 companies that we're working with. Today there's about 40% women and minority owned businesses we work with. 60% are owned or operated by men, and the majority of those are Caucasian. So we're moving toward a diversification goal, but we're not quite there yet. We've left open the fourth and fifth funds specifically to allow for us to target and structure the deal for individual investors or family offices that want to use this as an opportunity to support the growth and development of companies into the middle market. So those are still open for, as are the Series 2 and Series 3 funds. The risk involved, we think we have been able to mitigate pretty substantially. One is companies that receive loans from the debt fund must be members of TrueSpace. They must be members of TrueSpace for at least 3 months so that we get to know who they are. Part of being a member means you are we're working with these companies and the CEOs and the teams on a monthly basis. We know what they're doing with the money. We're tracking their financials. So our ability to get foresight into yeah, you just need to move here. There you go. Sorry. It's okay. You're still on. Our ability to identify early and course correct so that we're able to limit, probably not limit, but significantly mitigate fallouts on these loans is very good. The other positioning we've got is that we will be an either senior debt position or senior subordinated. Most of these companies have taken lines of credit out from banks. And our position will be to either recapitalize the loan from the bank or stand side by side with the bank. So it's a senior debt position that we're going to have. I'm going to tell you now about the analytics that we use based on the research that was done that gives us the ability to determine the capability for these mid-market companies to grow. And then, as I mentioned, the oversight is by the work that we're doing on a monthly basis with these companies and seeing where they are and helping them develop their strategy and execute their growth. So that's the overview of the fund. And I would obviously be happy to talk to anybody more, give you more in depth about the structure of the funds and how it works, but that's the high level.
Can you talk about what this membership is you keep on discussing?
Yeah.
And what's that all about and how does that work? I mean,
yeah, hold that thought.
Platform.
Hold that thought. I'm going to give you.
And to think about this, is this more, I mean, is this like venture lending or is it lower middle market, like the lowest middle market private equity lending or, you know, growth? I mean, where do you see yourself in that whole space of things?
Great question. And I want to tell you, I want to give you the context for the membership and the work that we're doing with them. So as I mentioned, I've run a number of companies and Charles Fred has started and sold 3 companies on his own. In this process, we have experienced the realities of why it's so hard to get from $1 million to the middle markets. But there was no data. And so we looked around to say, okay, well, there's a lot of data on startups and there's a lot of data on larger established companies, but what about this space between 1 million and 10 million? So that formed a 4-year research done by Charles and Jamie Fred. Spent 4 years in companies directly involved with the development and the growth of these companies over this 4-year period of time, hand to hand, interviewed exit interviews, interviewed people coming in, all of this development to try to figure out what is it that enables or keeps these companies that can make it to $1 million getting to the middle markets. So they studied 150 companies over a 4-year period of time. Over that time, 3 companies failed, just went out of business. 14 companies far exceeded the other 133 in growth. Same time period, 2014 to 2017, same time period. And then they did a compare and contrast. So what was it about the companies that flatlined, that couldn't grow, that didn't exist, or that was different in capabilities that these other 14 companies were able to do? They took this research and they applied against a couple of scientific methods. One is developed by a guy named Jay Forster at MIT. It's something called system dynamics. I'm not going to go through the details, but it is all around the development of what's called closed loop systems. It's the ability to track and measure inputs and outputs of activities. And they applied this research to the running of companies, the capabilities within companies. 150 companies, 14 of them became a benchmark for growth. They grew an average of 25% year over year for this 4-year period of time. They went from between 1 and 10 million into well into the middle markets, 30, 40 million in average revenues. 133 of them flatlined at about 5% growth a year. So the other science that they used was actually work done by Steve Jobs at PARC, Palo Alto Research Center, and it's something called ethnography. It's the interaction of people and systems and people and processes. And they put these 2 science-based methods against the research they did. They were able to come up with this is the system dynamics work, but let me jump to here. And they came up with the thesis that there are 5 operating conditions that existed consistently in these 14 companies that didn't exist consistently in the 133 that flatlined. They put together a framework that's is a system of inputs, which is on the far right-hand side. They're called flows that feed into closed loop systems. What's a closed loop system? The simplest example is to have a glass, which is the stock or the control, and the water that goes into the glass. That's the input, or in our case, the flow. And the person that is controlling the water going into the glass is the control mechanism. That's what creates a closed loop system. You can decide if you want a half full, half empty, full, uncontrolled water flow over. But the absence of having a control mechanism is fundamentally the reason companies spend money and go out of money without any result. They have no closed loop that's measuring what they're getting done, right? So that's the importance of the system dynamics. There are 30 flows that were identified. These are values that go into these 12 closed. This company capable of growing? Can it scale? Can it grow? Are the leaders in the management actually learning from the business? Do they have the systems and processes set up so that they can actually learn from, get the feedback that they need? Have they developed an environment so all the stakeholders are ready for the long haul? One of the interesting outcomes of the research was the average age of a company that makes it to 10 million is 12 years. So unlike what investors in Silicon Valley or most pitches will give you, it just takes a lot longer time to get to the middle markets than most people believe. It's one of the myths that was blown by the research. And the final one, which is an output of the other four, is the work you're doing actually creating enterprise value. Enterprise value measured by what? Measured by somebody that would come in and want to buy your business. And as you investors know, every business has a different set of dynamics that's applied. It's not just financial statements and balance sheets and cash flow statements. Every business has got different attributes that are valued depending on the type of investment and type of acquirer. So, created this framework. The next step that they did was they went to Gallup and they said, look, we've got 147 companies that we've identified, we've done the research, here's our thesis. We want you to put this against your database of 2,500 companies to either tell us we're full of shit or that we've got something here. They did that, and they came back, and it turns out that the work that they did, Gallup said was the highest correlation that they had performed since Gallup developed their assessment tool, which is called Skills Finder. So it's Gallup's floor of credibility is 0.7. The assessment that we do now with these companies has got a 0.876 correlation factor. So it's very high efficacy, very high standard for predicting whether or not these businesses can actually make it to the middle markets. We set up a 97 question assessment, which we call the 5 conditions assessment. And each question feeds into one of these flows or values that's in the framework that then summarizes and makes up the ultimately, where do you stand on each one of the operating conditions. Some interesting things about the assessment. One is, in addition to its correlations, very, very high statistically valid measure, the research came back and it said, you know what, unlike what a lot of people want to believe, the success of a business has nothing to do with your personal background, where you went to school, your college degree, nothing. It doesn't matter whether you're black, white, blue. It doesn't matter your gender, your ethnicity. So the survey that we do, this assessment that we do, is completely blind to who you are as an operator. It's taken by the executive teams that want to become members. We have them take this 97-point question. We get an output, and the output informs us where the management team views their capability to build the business. So it's their optics, it's just data, right? We use that then that frames the work that we do with our members. If they qualify to become a member, we use that work to determine where should they spend their time to create the greatest probability of making it to the middle markets, of successfully growing. This is a screenshot from the platform that we provide. So the beginning part that we say is, on an aggregate, you're in one of three stages of development. You're in emerging, which is 0 to 53. You are in what's called remodeling, which is a narrow band between 54 and 62, or you're in the benchmark, which is 63 and above. So we use this as a top level assessment. Companies that are candidates for the debt fund must be in remodeling. They must be above 53, because if they're in emerging, it doesn't matter how big they are or how long they've been in business. If you're still in emerging, you're still trying to figure it out. You haven't really figured out your capability of growing. So we start there. Our platform then allows us to take the data and start drilling down into interrogate where exactly should you apply your research and capital, your energy and capital to grow. And so we give them an aggregate assessment against each one of the conditions. We start with, and this is where I'm going to now close the loop with Marty's question: what is the membership? So if you're a company, you come in, you take the assessment, we can determine where you are in capability of growth based on a benchmark of 120 companies that Gallup refreshes about twice a year for us. So it's operating companies that are the aspiration of TrueSpace members. These are companies that 4 years ago were operating between 1 and 10 million. Over the last 3 years, they've grown at least 25%. And now today, the average revenue for the benchmark companies is about 35 million. So they're aspirational to where TrueSpace companies are. That's thing one. Thing two is, based on their 5 conditions assessment score, we determined whether they're really capable of growing. We use that then as the entry point to become a member of TrueSpace. If you're a member of TrueSpace, we start with this picture. The purple diagram is the shape of the business. This is what the company assesses themselves to be against these 12 closed loop systems, these 12 characteristics. Focus missions, you can see what they are. And then our work with the company is to say, okay, we're going to work on the gaps between where you see yourself and the benchmark. And we set up a game plan that we call a playbook. We sit down with every company and we start with the first work we do with them is, based on your 5 conditions assessment, let's put together a playbook that will be run over the next 12 months. So to be a member, you have to commit for 12 months because change doesn't happen inside of that. The CEO has to commit about 3% of his or her time as part of this effort. And as I said, the capital investment is $2,500 a month. It's $30,000 a year. So that's the beginning point. And we then, after the first year, in some cases, it depends on the dynamics, it's between 10 and 12 months later, we take another assessment and we say, did the work do us any good? Where now? Where do we focus? We get about, TrueSpace is about 55 companies, or 54 companies now. On a recurring basis, we get about 95% of the companies to continue on for a second year to work with us and to keep developing it out. The companies that don't have been acquired, in some cases, they just don't see they didn't get the value. Most of the time, the reason that a company would not continue with us is because they've developed and reached the benchmark and now they're on their way. So we've been able to get them there. But this shape of the business informs the work we do with the member companies over that 12-month playbook period. It allows us to specifically get the focus of the intention of the investment. The other thing we're able to do is the assessment tells us where the executive teams are aligned or where they're not. Again, it's not an attitude. It's not a behavioral test. It's simply the executive team's optics on the capability of the business based on their seat on the bus. And it gives us the data that says, okay, here's how you, in this particular case, are not very well aligned. So this is part of what we work on, right? So rather than saying you need to be aligned in your strategy, well, what the hell does that mean? Well, we can tell you precisely what that means because those lines are informed by 97 data points and 30 inputs to this system. So we can tell very precisely what they need to work on and where they need to go. We can also drill it down all the way down into how they rate their capability down to these 30 inputs, these 30 values or flows. And all this data we get by having them take the assessment. The assessment informs whether or not they're capable to really develop. Are they really ready to build and scale the company? If they are, and they want to make the commitment, they join TrueSpace. And a subset of those companies are the companies that we want to capitalize to help them develop their, execute on their growth.
I'm not sure if you've seen the questions that are on the screen, but you might want to answer, get to those in your chat, but I'll ask them, don't worry about it.
Yeah,
if
okay.
you don't see them.
Yeah.
But I have a question. Do people take the assessment before they join or after they join?
Before.
Is there a fee to take the assessment?
It costs $2,500 to take the assessment. If you become a member, it's rolled into the first year membership fee.
And that first year membership fee is what again?
$30,000, $2,500 a month. Yep.
But there's no guarantee they'll get a loan from you if they join.
No.
But it makes the likelihood based on the assessment score as it rises that they'll get a loan from someone.
Yeah, and not every TrueSpace member is a good candidate for debt, because some of them that are closer to $1 million can't service the debt, right? So you've got to have enough revenues to be able to service the debt over this 4-year period.
Do you refer people who are unqualified to somebody else?
Yes.
And
yes.
You refer people who are qualified, but you're not going to lend to them for whatever reason to
well,
other people as well?
If, our goal is to help these companies get to the middle markets. We're using the debt fund as a vehicle that allows them, to give them the capitalization if they can't find it. If they can get enough bank debt, God love them, go get the money to raise the money. But we know that they are going to get the money from banks because for the most part they're tapped out and they've got a line of credit. Many of these companies are at a point where if they can get valuation to where if they need $500,000 or $1 million, if they can get that through equity financing and they want to get it that way, that's another source of capital for them. So this is an alternative source of capital for known companies. Of the 50 some companies we've got, there's probably 15 today that are in play, ready candidates for the money.
And do you take warrants in the companies as well?
Depends on the size of the loan. If it's a $500,000 or more loan, we'll take a small amount of warrants. Think like 1 or 2%.
Okay, so let me just get to the questions. I maybe have 5 minutes left, but
sure.
Okay, question was, do you take warrants or something like that? What are the gross rates and fees to the borrowers?
The fees to, the rates to the borrowers are going to be in the 10 to 12%, depending on the profile of the company and amount of money and so forth. Yeah.
What's the estimated default rate?
Well, we haven't had anybody default yet. We're early into this, right? So the data that I've done says it's about 1.7% default for this size stage company and this size loans.
Based on a certain assessment score, or
no, just based on debt lending. Just
I was just wondering if there's a
just
feedback
market
loop, into the model.
There will be, but it's part of the data we're collecting. But
How
so far,
is this distinctively different than the DMAIC process? I don't know what that is. DMAIC?
I don't know, DMA. Maybe they can give me the
And Ron
acronym.
Botoff, if you're there, it would be great if you can just, write what DMAIC is. Or isn't this an overlay of DMAIC process? Another guy asked, have you thought about doing this as a CDFI?
No, we looked at a lot of different deal structures. One of our goals is to keep it really simple. Another goal is for us to mitigate the risk of the investment by virtue of knowing these companies pretty deeply, using this 5 conditions assessment as an investment due diligence. And again, on the investor side, we looked at, well, how do you manage this with variable interest rates and potential inflation and yada, yada, yada. We just said, look, we're going to lock it in at a committed 8%. It's a short-term note, 4-year note. It operates very much like a real estate investment. On a monthly basis, you're going to get principal and interest, your pro rata principal and interest paid back. The fund is our fund is management fees are funded by the spread between what we can charge and the 8%. So there's no management carry that we're taking on the investment money. So 100% of the investment money coming in by fund investors gets deployed.
Great. So Ron said that it means DMAIC is a continuous improvement process.
Yeah, so there's a number of different, I don't know if Ron, feel free to reach out to me directly. You can take this further, but there are a number of different execution models that companies that, different firms and different organizations have brought to this stage company. Some of them are really around just how do you run meetings, and some of them are clearly strategy. The TrueSpace business really is to specifically address companies from 1 to 10 million. And the reason is because we know by experience, there's just not a very good ecosystem of formulaic programs for those companies.
Do SBICs not invest into that?
So there are another source of funding for a lot of these companies today, if they can wait long enough to get it, is economic impact development loans from it's 3% 30-year money. Okay. It's great money if they can get it. Yeah.
Do you have any data on the number who will get those loans out of the number of people who apply, or
of the SBI loans? I don't know. I think. Yeah, I don't. I do know, having of the companies that I'm working with directly, there are 20 companies at least that have applied, that are waiting for the money. And the problem is they got businesses to grow, and they're waiting for the government. I mean, it's tough, right?
Sure. I mean, so obviously they're paying for the time sensitivity, right?
Yeah.
And what's the duration of your loans?
4 years, 48 months. Yeah, 48 months. And again, the typical size, our model size is about 500,000. We're not going to go less than 250. We're not going to go over 750. We fully anticipate that as we get into some of these largers, we'll do side-by-side venture funding with it. So it'll take the shape of a venture debt. But
are there any industries that you don't invest, that you don't lend to?
Yeah, we don't work with retail storefronts, just because they don't have the capability of really growing.
Restaurant?
Multi-chain restaurants, if they're big, yeah, we will. But 2 or 3 shops in a store in a town, they just don't have the capability. But that profile is filtered out by taking this 5 conditions assessment. So we know that coming in.
Perfect, great. Yeah. Fantastic, bud. Really informative. Thanks so much.
Thank you.